We're going to resume our discussion of break-even analysis. Now, companies are not in business just to break even. Companies are in business, unless you're a nonprofit, to make profits. Now, so the question becomes, well, how much do you have to sell in order to hit a certain targeted profit? And how much is that in dollars? How much is that in units? And this is important not only because management may be setting targeted sales goals for the the sales force to meet, but there also may be investors, and investors may have an expectation of certain profit targets being met. And so a company needs to know what sales need to be in order to hit profits. And this is the way to calculate that. So we can calculate target profits in terms of units. We can calculate target profits in terms of sales dollars. And here is the analysis. We take our fixed costs plus our desired profit and divide that by the contribution margin unit. If we're going to do it in dollars, the numerator is the same. However, the denominator is the contribution margin ratio. So if you think about this, this is really no different than the break-even calculation we did a minute ago. If we had fixed costs plus a desired profit of 0, which would be the break-even, this is just, again, the same calculation as the break-even, except to the numerator we are adding our desired profit. And so we've got there we go. Okay. So we've got Hicks here, and they want to earn 16,000. What do they need to sell in order to, in terms of number of units? And so we've got our fixed costs plus the targeted profits. Now, these are not sales dollars. This is what they want to be able to put in their pockets after costs have been achieved. They divide that by the $80 per unit contribution margin, and that tells them that they've got to sell 425 units in order to achieve 16,000 in your pocket profits. Now, this is of course what I get for attempting to use free resources, because it was only as I started recording the target profit calculation did I realize that they made an error on the slide, so I have now fixed that. Now let's say we need to figure out what we need to sell in terms of dollars in order to achieve that $16,000 in your pocket profit. So in this case, again, numerator exactly the same, 18,000 in fixed costs plus what we want to walk away with in profit, which in this case is $16,000. Denominator, on the other hand, is our contribution margin ratio, and that tells us that we need to sell $42,500 in order to be left with $16,000 that we want to in the end. And here is the numerical calculation, sort of setting all that out in income statement format so that you can see that what we are left with, we've got a contribution margin of 34,000 to cover 18,000 in fixed costs, leaving us 16,000. Now, unfortunately, the tax man cometh. And while we would like to say, well, a company who has 16,000 in profits gets to keep all of it, we know that that's not the case. Companies have to pay taxes, individuals have to pay taxes. And so quite often companies are looking at their targets in terms of their after-tax profits. So just calculating the pre-tax profit isn't as meaningful. They want to know what their post-tax profits are going to be. So in order to do that, we have to take the desired after-tax profits, and we've got to convert that to a pre-tax number first before we plug that into the formulas we were just using. Now, here's how we do that. We take the after-tax profit that we want, and this is not a calculation here. This is a hyphenated word, which is after and tax profit. So if we have an after-tax profit that we want to achieve of a certain amount, in order to convert that to pre-tax, we put the after-tax profit in the numerator, and the denominator is 1 minus the tax rate. This will all hopefully make sense in a minute. Because then that will get us back to the pre-tax money that we were using in the last slide example, and that gets plugged right into either of the two formulas, whether you're looking for targets in terms of units or dollars, still the same numerator. And so just instead of desired profit, it now says desired pre-tax profit. And so this is basically what this looks like in terms of a calculation. We've got Hicks and their bird baths. They get taxed at 40%. This is also an old slide because the corporate tax rate's nowhere near that. But anyway, I digress. And they want to earn $24,000 after tax. So in other words, they have their pre-tax amount, they pay income tax, and after that income tax figure, they want to have $24,000 left over in free money to them to do with as they choose. So the first thing that we need to do is to figure out what that $24,000 actually is in pre-tax dollars. So in order to do that, we have the 24,000 and as the numerator, and then 1 times the 40% tax rate as the denominator. And what that tells us is that that converts to $40,000 in pre-tax money. Okay, so now what do we have to sell in units to be able to, in pre-tax money, achieve $40,000 such that after it's taxed, we still have the $24,000 left? And here's the calculation. We still have our fixed costs now plus our pre-tax profit, desired profit, over the contribution margin per unit, and that tells us that we've got to sell 725 units to not only cover our fixed costs and our variable costs, but our income tax, and walk away with $24,000 in the end. And similarly, to convert that to dollars, we have to earn $72,500 in sales in order to achieve that desired after-tax profit of $24,000. And that is a reasonably common calculation. So you may want to, in terms of being able to convert after-tax and pre-tax dollars, that's a calculation you're going to want to hang on to, because you will revisit that throughout your career. So not only do merchandisers, I've talked about manufacturers, use the cost volume profit analysis, but so do service companies. I am a service company, and when I start looking at my hourly rate that I'm going to charge clients, I certainly look at that in terms of, okay, how much of that is covering fixed costs, how much of that is covering variable costs, and what's left over to go in my pocket at the end. So in this example, they've got, I think, an accounting firm, and they're using income tax returns as the way to calculate this. So they are doing it on a per return basis. I do it for me. When I look at this, I'm charging by the hour, so I'm carving this up in terms of hours as opposed to a discrete service the way that they've done here. They've got their variable cost per return and then their total fixed costs. So again, just because this isn't a tangible physical product they're selling doesn't mean that the same analysis that we've talked about with the bird baths doesn't apply. They can do the very same calculation to figure out how many returns they need to do in order to break even in terms of dollars, in terms of number of returns. And then if they want to start achieving operating profit, both pre and post-tax, they can also, again, drop those numbers in the very same way. So, sorry, brief interruption. So we're back here, and we see that for this service company, they are going to use, again, these very same calculations to achieve their break-even point in units and in dollars. So we've got total fixed costs divided by contribution margin per unit, and then total fixed costs divided by the contribution margin ratio to get the break-even in dollars. Now remember, once we are trying to achieve targeted profits, the only thing we need to change in this calculation is we just, to the numerator, need to add what our desired target profit is, and the rest of the calculation remains the same. Because if you think about it, this is, to achieve a break-even point with 0 target profit, that's effectively what this calculation does. So this is, again, different calculation using that desired profit figure. All we've done is plug that in to take us from the break-even point to achieving a target. So I'm going to skip over these next couple slides and go on to the next video to start talking about sensitivity analysis.